The American dream has always had a specific address. For decades, that address was a suburban home with a manicured lawn, a reliable mortgage, and the quiet assurance that, given enough time, the dirt beneath your feet would become your greatest financial fortress. If you are over 45, you likely grew up with this gospel. Real estate wasn't just an asset. It was the ultimate hedge against inflation, the bedrock of the middle class, and the primary vehicle for generational wealth. But as we move through 22-6, a quiet but profound shift is occurring at the highest levels of the American economy. The ultra-wealthy, the institutional giants, and the smartest money in the room are no longer doubling down on the U.S. residential market. In fact, they are quietly moving their capital elsewhere. This isn't a sudden crash or a headline-grabbing panic. It is something far more surgical. It is a calculated exit from an asset class that has become too expensive to maintain, too regulated to grow, and too risky to hold in an era of persistent inflation and shifting demographics. While the average American family is still being told that a home is their best investment, those who actually move the markets are looking at a different map entirely. Before we dive into the data that explains this migration of capital, I want to invite you to join our community. If you value deep, calm analysis of the economic forces affecting your retirement and your future, please consider subscribing to the channel. We focus on providing the clarity you won't find in the 24-hour news cycle, helping you navigate these complex times with confidence. The logical framework for real estate has been inverted. For nearly 15 years, we lived in a world of free money. Low interest rates acted as a massive tailwind, pushing property values to heights that disconnected them from local wages. But the environment of 2026 is fundamentally different. Even as the Federal Reserve attempts to find a neutral ground, the era of 3% mortgages is a ghost of the past. For the wealthy, real estate is a math problem. When the cost of debt rises and stays elevated, the cap rate, the return on a property, must also rise to stay competitive. However, in many American markets, rents have hit a ceiling. The middle class, squeezed by the rising cost of living, simply cannot pay more. This creates a trap. Property values remain high due to low inventory, but the actual cash flow potential is shrinking. The wealthy are looking at this and realizing that the risk-to-reward ratio has broken. They are seeing that they can get similar or better returns in private credit or high-yield infrastructure projects without the headaches of property taxes, insurance premiums that have doubled in the last 3 years, and the ongoing maintenance of physical assets. This brings us to a structural revelation that most individual investors ignore: the death of the tax haven status of U.S. real estate. Historically, depreciation and 1031 exchanges made real estate the darling of the tax code. But as state and local governments face massive budget deficits, they are turning to property owners to fill the gap. From California to Florida, we are seeing a hidden inflation in the form of soaring property taxes and uninsurable zones. A mansion in the Sun Belt that looked like a bargain in 2021 now carries a carrying cost that rivals a small business's payroll. The wealthy aren't just selling because they think prices will drop. They are selling because the cost of ownership has outpaced the rate of appreciation. They are moving into liquid alternatives, assets that can be moved with a keystroke, rather than being tethered to a piece of land that is increasingly becoming a liability to the state. If you are finding this analysis helpful in understanding the broader movements of the 2026 economy, this is a great moment to subscribe and hit the notification bell. Our goal is to ensure you stay ahead of the curve as the rules of wealth preservation continue to change. The practical implication for the viewer, especially those approaching or currently in retirement, is a need for a psychological pivot. For the last 20 years, the mantra was buy and hold real estate at all costs. But in today's landscape, your primary residence should be viewed as a place to live, not a guaranteed piggy bank. The wealth effect that many felt during the post-pandemic boom is evaporating as liquidity dries up. If the smartest investors are moving toward private credit, data centers, and international infrastructure, it suggests that the easy money in U.S. residential real estate has already been made. This doesn't mean you should sell your home in a panic, but it does mean you should be wary of over-allocating your net worth into a single illiquid asset. Diversification is no longer a suggestion, it is a survival strategy. The wealthy are seeking yield without friction, and currently the U.S. housing market is nothing but friction. As we look toward the remainder of the year, we are witnessing the end of an era. The transition from a real estate-obsessed economy to one driven by technology, energy, and private lending is well underway. The silence of this transition is what makes it so dangerous for those who aren't paying attention. The houses will still be there, the lawns will still be green, and the neighborhood signs will still look the same. But the underlying value, the engine of growth that fueled the American middle class for 70 years, is being redirected. It is a quiet exodus, a sophisticated migration of capital that leaves the door open for those who arrive late to the party to turn off the lights. Thank you for spending your time with me today. If you found this perspective valuable, please subscribe to the channel and share this video with someone who is thinking about their financial future. It's the best way to support our work and ensure we can keep bringing you these deep dives. Until next time, stay vigilant and stay informed.